Managerial accounting, manufacturers, cost flows. Now we've seen how materials are purchased and recorded in raw materials inventory, and then when materials are requisitioned into production, their costs flow out of raw materials inventory into work in process inventory, and we add labor and overhead costs to the raw materials to convert them into a finished product. And then when the finished product, when the product is finished, the costs flow out of work in process. And the account into which those costs flow is the finished goods inventory account. Now, like raw materials and work in process, finished goods will probably have a balance in it as we begin the period. That's going to be the cost of units that were completed last period but had not yet been sold by the end of last period. Last period's ending balance is this period's beginning balance. To that balance from work in process, we will add the cost of the completed units, which is called cost of goods manufactured. Now, the next thing that happens in the cost flow is that the product is actually sold to the customer. And when that happens, the cost of that product comes out of finished goods inventory and is recorded as an income statement expense, cost of goods sold. So again, cost of goods sold is an income statement account. And specifically is an expense that is subtracted directly from sales in determining gross profit or gross margin, the key profit figure for a manufacturer. If we don't cover the cost of the products we've produced, then it's highly unlikely that we'll be able to cover or provide a profit to shareholders. So that's a very important number, and you'll see that calculation in the video on the manufacturer's income statement. So beginning balance of finished goods plus cost of goods manufactured, which comes out of work in process, minus the cost of units sold during the period, cost of goods sold, is going to yield the ending balance. Of finished goods, which, just like raw materials ending inventory and work in process ending inventory, is reported on the balance sheet as an asset. And that completes the cost flows for a manufacturer. We start with raw materials. Those materials are requisitioned into production, and the costs are recorded in work in process inventory. In that same factory inventory account, we add the cost of labor to assemble the materials or convert the materials into a finished product. We add the indirect cost, manufacturing overhead, to the work in process inventory account. And then when units are completed, physically they flow into a finished goods warehouse, and in the accounts the costs do the same thing. They flow out of work in process into finished goods inventory. And then finally, when the units are actually sold and delivered to customers, their costs come out of inventory and off the balance sheet and are recorded in the expense account, cost of goods sold, on the income statement.